Greetings, comrades. The quick asset ratio is a liquidity indicator which provides a measure of the ability to pay short-term debts as they fall due. Now, the QAR is one of 3 liquidity indicators that we have in the VCE course. I've already done a clip on working capital ratio. We've got one brewing for the cash flow cover. Now, in terms of what we mean by quick assets, they're simply assets that can be quickly and easily converted into cash. Now, if we compare our formulas for quick asset versus our working capital ratio, we can see that they're similar. They've both got the same denominator, current liabilities. The difference is for our QAR, we are subtracting, not including our inventory and our prepayments. These are not considered quick assets. These will take time to convert to cash. For instance, prepayments. Take insurance. If we prepay an insurance at 12 months in advance, that's going to be very difficult to liquidate that and convert that into cash with our company, which we have the insurance policy with. And depending on what type of industry you're in, inventory can also be slow at converting to cash. If we've got a slow cash cycle, first of all, we have to sell the inventory. If we're doing that on credit, then we need additional time to chase up the funds from our accounts receivable. Now, as outlined in a couple of the other financial indicator videos that I've done, I recommend that you adopt the D approach when you are asked to evaluate the QAR. Define the ratio, define what we mean by quick asset ratio, put it in dollars terms to give it context, and then draw on the data to demonstrate that higher order thinking in order to show the assessor that you know how to unpack this ratio and explain the implications in terms of the liquidity of the business. So let's have a look at an example. So first of all, we need to identify our quick assets. So therefore, we're not going to include our inventory. We're not going to include our prepayments. So therefore, our quick assets simply is the 10K in accounts receivable and another 10K from our bank. So therefore, we've only got 20K in quick assets versus 80K worth of current liabilities. So as stipulated by the study design in terms of the outline of the formulas, we do express QAR as a ratio to 1. So therefore, we convert that 20,000, we divide it by 80,000, and we get a QAR of 0.25 to 1, as opposed to our working capital ratio, which is literally 10 times that. 200K to 80K equals 2.5 to 1. So let's have a look at how we unpack this in terms of our D evaluation. So the first D, a definition. We start by stating that QAR is a measure of the ability to pay off immediate debts as they fall due via a comparison of our quick assets to our current liabilities. Our second D, then we convert the ratio into dollars to contextualize it. For every $1 of current liabilities, our denominator, there's just a 25 cents worth of quick assets, and a little explanation that these are the assets that can be rapidly converted to cash. Now, I'm going to go a little bit rogue on this video because we can calculate, and we have calculated the working capital ratio 2.51. So in terms of drawing on the data to again demonstrate that higher order thinking in terms of evaluation of our liquidity, let's just start by unpacking that the working capital ratio is solid, but $2.50 of current assets for every $1 of current liabilities. But then we poo-poo it by saying that 90% of those current assets are tied up in our inventory and our prepaid insurance. These assets cannot be easily and rapidly converted to cash. So then we expand on that by saying that this business has a liquidity crisis. They're not in a position to pay off their pending debts as they fall due because there's not enough quick assets that they can liquidate. E.g., and this is where you want to actually bring in the data by looking at some of the current liabilities. There's not enough money to pay off our suppliers, the accounts payable. There's not enough money in the bank to pay off the loan, depending on when that's due. And we're not well placed to pay off the accrued wages to the staff from the work they did in the previous reporting period.